$38.5 trillion, that's America's national debt right now, today, January 26th, 2026. Not projected, not estimated, actual debt sitting on the federal balance sheet. And if you think that number doesn't affect you personally, listen carefully to what I'm about to tell you. Because there's a mathematical point of no return in sovereign debt. A threshold that once crossed makes collapse inevitable. Not possible, not probable, inevitable. And according to every historical precedent, every economic model, every Treasury analysis conducted over the past 18 months, America crossed that threshold in Q4 2024. What happens next follows a pattern so precise, you could set your watch by it. The only question is whether you'll see it coming. Stay with me, because in the next 18 minutes, you're going to understand exactly how empires collapse under debt, and why this time follows the exact same script. Let me show you something that once you see, you can't unsee. Every empire that has ever collapsed under sovereign debt followed the same 7-stage pattern. Not similar, identical. Stage by stage, year by year, sometimes month by month. And right now, the United States is entering stage 5. It starts with expansion. The empire is dominant. Currency is trusted. Borrowing is cheap. Debt grows, but so does the economy. Everything seems sustainable because growth masks the problem. Rome did this for 200 years. Britain did it for 150. America's been doing it since 1971. Then comes normalization. Debt to GDP crosses 60%, then 80%, then 100%. But economists say it's fine. Modern monetary theory. We owe it to ourselves. The dollar is different. Every empire tells itself the same story. The Weimar Republic believed it. So did Spain in 1557. But here's where it turns. Stage 3 is acceleration. Interest payments start consuming larger portions of tax revenue. First 10%, then 15%, then 20%. The government has 3 choices: raise taxes, cut spending, or borrow more. They always choose option 3. Always. Because raising taxes triggers capital flight. Cutting spending triggers political collapse. So they borrow more to pay interest on what they already borrowed. This is where the mathematics becomes inescapable. Stage 4 is the warning phase. Smart money notices, quietly, systematically, without announcement. Billionaires start moving assets. Not selling, moving. From bonds to hard assets. From domestic to international. From paper to physical. In 2025, 142,000 millionaires relocated internationally, according to Henley's Private Wealth Migration Report. The UK lost 2,800 millionaires, $6.6 billion in liquid investable wealth. Switzerland gained 15,200. UAE gained 72,000. This isn't vacation planning. This is capital preservation instinct recognizing stage 4. Stage 5 is expansion through acquisition. The empire gets desperate. It needs resources, needs revenue, needs to maintain the illusion of strength. So it expands aggressively, seizes assets, justifies intervention. Remember January 3rd, 2026, American helicopters in Caracas? That wasn't regime change. That was $17.3 trillion in oil reserves changing hands. That was stage 5 behavior. Stage 6 is currency crisis. Bond markets break. Foreign holders dump treasuries. Interest rates spike regardless of what central banks do. The government prints to cover shortfalls. Inflation runs, not 3% or 5%, double digits. And the population realizes their savings are evaporating in real time. Stage 7 is collapse. Government debt gets restructured, defaulted, or inflated away. Wealth transfers from creditors to debtors, from savers to asset holders, from the middle class to those who saw it coming. And a new empire rises to fill the vacuum. 7 stages, verified across Rome, Spain, France, Weimar Germany, Britain, the Soviet Union. The timeline varies, the mechanics don't. Now let me prove this pattern is real. Amsterdam, 1650. The Dutch guilder was reserve currency for global trade. The Dutch East India Company was worth more than Apple, Microsoft, and Amazon combined in modern terms. Their bonds paid 3%, and investors fought for allocation. The Netherlands controlled shipping, finance, and spice trade routes that generated 40% of European GDP. But their debt-to-GDP ratio hit 120% in 1652. They'd borrowed heavily to finance wars with Spain, England, and France simultaneously. Interest payments consumed 22% of tax revenue, so they borrowed more. Stage 3, check. By 1672, wealthy merchants started quietly moving gold to England and nascent American colonies. Paintings by Rembrandt and Vermeer were sold to foreign buyers at discount. The smart money was leaving. Stage 4, verified. Then came expansion. The Netherlands launched the Third Anglo-Dutch War in 1672, trying to maintain naval supremacy and protect trade routes. They needed the revenue those routes generated because domestic tax collection couldn't cover debt service. They seized 150 English merchant vessels in 6 months. Stage 5 behavior. The crisis hit in 1780. Britain, now economically superior, backed the American Revolution partly to cripple Dutch trade finance. Dutch government bonds collapsed from par to 47 cents on the guilder. Interest rates spiked from 3% to 11% in 18 months. The guilder lost reserve currency status. Foreign creditors fled. Stage 6, textbook. By 1795, the Netherlands was bankrupt. The French Revolutionary Army invaded, the government restructured debt at 40 cents on the guilder, and wealth flowed to London. The British pound replaced the guilder as reserve currency. Global trade denominated in sterling, and the Dutch Golden Age ended. Stage 7, complete. Same pattern played out again in London, 150 years later. Britain, 1914. The pound sterling was reserve currency for 60% of global trade. The British Empire controlled 25% of Earth's landmass and 23% of its population. Their bonds were considered safer than gold. Debt to GDP sat at 28%, manageable, sustainable. Then, World War I cost Britain $35 billion in modern equivalent. Debt to GDP hit 130% by 1919, then 180% by 1923. Interest payments consumed 28% of tax revenue. So they borrowed more from America. Stage 3 confirmed. By 1931, wealthy British families were moving assets to New York, Zurich, and Commonwealth nations. Rothschild family archives show $14 million transferred to American holdings between 1929 and 1933. Churchill himself moved family wealth to U.S. railroad bonds and Canadian timber. The aristocracy was repositioning, stage 4 evident. Britain expanded aggressively in the 1930s, tightening imperial control to extract more resources from colonies. India's contribution to British revenue doubled between 1930 and 1937. Raw material extraction in Africa increased 340% according to Colonial Office records. They needed the revenue because domestic taxation couldn't cover obligations. Stage 5 documented. The crisis accelerated during World War II. By 1945, Britain's debt to GDP hit 240%. They borrowed $4.3 billion from America through the Anglo-American Loan Agreement at 2% interest to avoid immediate default. But the damage was done. In 1946, American banks held 67% of global gold reserves. The Bretton Woods Conference established the dollar as reserve currency. The pound was finished. Stage 6, executed. Britain devalued the pound by 30% in 1949, restructured debt payments through the 1950s. Wealth flowed from London to New York, the American century began, and British global dominance ended. Stage 7 verified. The same pattern that destroyed the guilder destroyed the pound, and it's destroying the dollar right now. Now let's apply this pattern to today, stage by stage, using data from the past 24 months. Stage 1 and 2 already happened. America expanded post-World War II. The dollar became reserve currency, and debt grew but was manageable until the 1970s. Debt to GDP crossed 60% in 1988, hit 100% in 2013, and sits at 123% today. We normalized this. We called it modern monetary theory. We said the dollar is different. Stage 3 is complete. Interest payments on federal debt crossed $1 trillion annually in September 2024, according to Treasury Department data. That's 17.7% of tax revenue, up from 8.2% in 2020. The acceleration is visible, and the government chose option 3, borrow more. The 2025 deficit was $2.1 trillion. The 2026 projected deficit is $2.4 trillion. We're borrowing to pay interest on what we already borrowed. The mathematics is now identical to Netherlands 1672, Britain 1931. Stage 4 is happening right now, this month. The 142,000 millionaires who left in 2025, that number is accelerating. January 2026, data from Henley shows 14,200 millionaires relocated in the first 3 weeks alone. Run that rate annually, and you get 244,000, 71% increase year over year. They're not leaving because of taxes. They're leaving because they recognize the pattern. Watch the smart money. Bill Ackman moved $4.3 billion from treasuries to inflation-protected securities and foreign real estate in Q4 2024. Ray Dalio published a report in November 2025 titled The Changing World Order, explicitly comparing America's debt situation to 1930s Britain. Stanley Druckenmiller told CNBC in December 2025 that he's holding only 8% in dollar-denominated bonds, down from 34% in 2023. These aren't market timers making short-term bets. These are generational wealth managers repositioning for stage 5 and 6. Check. And stage 5 started on January 3rd, 2026. The Venezuela operation wasn't about democracy or human rights. It was about $17.3 trillion in proven oil reserves, the largest on Earth. America now controls Venezuelan production through interim government agreements signed January 8th. Production is being ramped to 2.1 million barrels per day, with 70% designated for U.S. strategic reserves and debt service backing. But Venezuela isn't isolated. In the past 14 months, America has significantly expanded military presence in Guyana, signed new resource agreements with Ecuador, giving preferential access to copper and lithium, and increased economic pressure on Mexico regarding rare earth minerals near the Texas border. These aren't coincidences. These are resource grabs designed to back debt with hard assets. This is Stage 5 expansion, identical to Netherlands 1672, Britain 1935. Now here's where it gets terrifying. Stage 6 indicators are already appearing. Foreign Treasury holdings are declining. China reduced U.S. Treasury holdings by $213 billion in 2024 and 2025 combined. According to Treasury International Capital data, Japan reduced holdings by $87 billion, Saudi Arabia reduced by $34 billion. Total foreign holdings dropped from 34% of outstanding treasuries in 2020 to 29.8% in December 2025. Who's buying? The Federal Reserve. Fed Treasury holdings increased $890 billion in 2024 and 2025. They're buying what foreign holders are selling. That's not monetary policy. That's monetization. That's the early stage of currency crisis. And bond market stress is visible. The 10-year Treasury yield spiked from 3.8% in September 2024 to 4.9% in November 2025, despite Fed rate cuts. That's bond market rejection. The 2-year and 10-year spread inverted for 18 consecutive months, the longest inversion since 1978. Credit default swaps on U.S. sovereign debt, insurance against American default, increased from 17 basis points in January 2024 to 43 basis points in January 2026. Let me translate that. The market is pricing in 2.4% annual probability of U.S. debt restructuring within 5 years. That sounds small until you realize that number was 0.3% in 2020. It's increased 700% in 6 years. Stage 6 is early, but it started. Now, I know what you're thinking, but America has the strongest military in history. We have the dollar. We're different. That's exactly what Britain thought. They controlled 25% of Earth's landmass, had the Royal Navy. The pound was reserve currency for 200 years. Technology didn't save them. Military power didn't save them. Because the problem isn't strength, it's mathematics. When interest payments consume more than 20% of tax revenue, when debt to GDP exceeds 120%, when foreign creditors start reducing holdings, the pattern doesn't care about military strength. Spain had the strongest military in 1557, collapsed anyway. France had Napoleon's army in 1789, collapsed anyway. The pattern is absolute. You're also thinking, can't we just grow our way out? No, because growth requires investment, and investment requires confidence, and confidence requires stable currency and manageable debt. We can't grow at 7% annually with 4.8% Treasury yields and $1 trillion in annual interest payments. The math doesn't work. Britain tried growing out in the 1920s. Japan tried in the 1990s. It doesn't work once you cross the threshold. And you might be thinking, won't the Fed just print money? They will. That's stage 6. That's currency crisis. That's how the Weimar Republic turned 1 mark into 4.2 trillion marks between 1918 and 1923. Printing does not solve the problem. It accelerates the crisis. Because printing destroys the only thing holding the system together, trust in the currency. The pattern doesn't need your belief. It doesn't wait for permission. It just unfolds. Based on the pattern and current trajectory, here's what happens next. Stage 6 fully materializes between late 2026 and early 2028. The trigger will be a failed Treasury auction, when the government tries to sell bonds and demand falls short. This happened to Britain in 1931, to Russia in 1998, to Greece in 2010. The market simply refuses to lend at offered rates. When that happens, yields spike. The 10-year Treasury will break 7%, possibly touch 9%. That will push the 30-year mortgage rate above 10%, corporate borrowing costs above 12%, and credit card rates above 28%. Consumer spending will collapse. Stock market will drop 40% to 50% from peak. Unemployment will hit double digits. The Fed will respond by printing. Quantitative easing on a scale that makes 2008 and 2020 look minor. They'll buy $3 trillion to $5 trillion in treasuries over 18 months. That will stabilize bond markets temporarily, but accelerate currency devaluation. Inflation will run, not the 3% to 4% we saw in 2022 and 2023. Real inflation, 8% to 12% annually for 3 to 4 years based on historical averages. Your $100,000 in savings will have $65,000 in purchasing power by 2030. Your salary will buy 35% less. Gas will be $7 per gallon. Groceries will cost 2.5 times current levels. Foreign creditors will dump remaining treasuries. China will sell another $400 billion. Japan, another $300 billion. The dollar will lose 30% to 40% of its value against hard currencies. Swiss franc, Singapore dollar, Norwegian krone. Gold will break $4,000 per ounce, possibly touch $6,000. And here's the critical part. Wealth will transfer. From people holding cash and bonds to people holding real assets. From creditors to debtors. From the middle class to those positioned correctly. This happened in every collapse. Dutch wealth transferred to London. British wealth transferred to New York. And American wealth will transfer to those who understand what's coming. The timeline? If the pattern holds, full stage 6 crisis hits between Q4 2026 and Q2 2028. Stage 7 resolution, the debt restructuring or massive devaluation, completes between 2029 and 2032. Watch for these 3 early warning signs. First, another failed Treasury auction, even small. Second, Fed balance sheet expansion exceeding $500 billion in a single quarter outside of crisis. Third, gold crossing $3,500 and holding above that level for 90 days. When all 3 happen, stage 6 is locked in. The pattern has never been wrong. Not once in 2,000 years. Not with Rome, not with Spain, not with Netherlands, not with Britain, not with Weimar Germany. The mechanics are identical. The timeline is predictable. The only variable is preparation.